everyone, and thank you for joining today's session. I know we all have busy schedules, so I really, really appreciate you taking the time to be here. For all of those of you who don't know me, my name is Dr. Nkem Ezamama, and I'm an ER physician, and I'm in the Nashville area. I'm the CEO and founder of Phoenix Capital Investment, and our main goal at Phoenix is really to help busy professionals, whether they're in or out of healthcare, to build passive income through apartment real estate investing. So today we will actually be talking about one of the most important topics in passive investors, and it's the question that they always ask: like, how do I know if this real estate deal is truly a good investment? Right? There's so much information out there. You hear all these big numbers, projected returns. You hear about like who this person is, or who that person is, or who the sponsor is. You hear about market trends, and it's very easy to feel overwhelmed, right? But the truth is that making a great investment decision, it comes down to three things. And these are three critical factors. It's the market, it's a deal, and it's the sponsor. If one of these are off, you could be putting money into something that is pretty much a risky investment, right? So by the end of this hour and a half session that we're going to talk about tonight, I want to give you the step-by-step framework in how you evaluate any deal, and with confidence, right? So that you can start making smart investment decisions and grow your wealth, which is what I want you to do. So like I said earlier, use the questions, use the Q&A, use the chat, just ask any questions. I'd love to answer. And then at the end, I'll gather everything and be able to answer questions. But so I want to ask you a question, just something for you to think about, right? How many of you have ever seen a deal and thought, wow, this looks really good. This looks like a really great investment, only to realize later that it wasn't what it seemed, or maybe you heard from someone that it wasn't what it seemed, right? I think that's one of the biggest mistakes that passive investors make. They focus on that number, that high projected return, and you'll hear me say that a few times, but instead of really fully understanding what they're investing in, right? Because a deal can look good on paper, but what happens if you're buying it in a market that is declining? Or what happens if the business plan is unrealistic, like it doesn't make sense? Or worse, what happens if the team who's sponsoring the deal, if they lack the skills to really execute on the business plan that they said they were going to? So that is why today I want to break down the three essential factors that you must know and you must understand in order to evaluate a deal. And that is the market, the deal, and the sponsor. And I'll break that down into very crystal clear points. But at the end of the session, like I said, I want you to have a clear step-by-step framework that you can approach any deal and invest with confidence, or approach any deal and decide this is really not a good deal. It's because I don't want you to rely on like flashy marketing materials or like really beautiful, like spreadsheets that might be steering you in the wrong direction. So now that we kind of understand some of the biggest mistakes we make, right? I want us to talk about really how to properly evaluate a deal. And I told you that we will go deep in three areas, which is the market. The first one is the market. So where is the property located, right? A strong market can save a mediocre deal, a deal that wasn't doing well. But if that deal is situated in a strong market, it can save it. But a weak market will kill even the best investment opportunity. So that's something that you have to remember. So when you're thinking about market, what are you thinking about, right? You're seeing like, are people moving out? Are jobs declining? Is there any economic growth? Or is there like a business plan that makes sense, right? That's what you have to think about when you're thinking about the market. And then when you think about the deal, right? What are the numbers? What is the business plan? Because a property is not just bricks and wall, right? A property is a business. So what is the business plan? Is there something called value add? Is it a value add strategy that you go in and you renovate some units and then you increase rent? Or is it what we call a repositioning strategy, where you go in and you like gut and you like almost take everything to the studs and build it back up? Or is it a stabilized asset where there's not much to do, but you know that you're getting steady income? So what is the business plan? And then you have to understand the strategy behind it and understand the risks as well. And then the third area that we're going to delve into is who is managing the money. So who is the sponsor? Who's the team that you're trusting, right? I'll say this, a great deal in a really great market will still fail if it's in the hands of sponsors who don't have any experience or who lack integrity. So when you're asking these questions, you have to get down to the foundation. You also have to ask, like, who's executing the business plan? What type of track record do they have? Are they protecting your investor capital and making smart decisions? These are questions that I want you to ask. I want you to be thinking about as you start, becoming a savvy investor. The truth is, a truly great investment happens when all three of those factors align, when it's in a great market, when the numbers make sense, and when the sponsor has a great track record and is upright. But if one of them are weak, right, the risk increases significantly. It might not necessarily be a bad deal, but that risk goes up, right? So now we talked about just that in brief. I want to go in and delve a little bit more into the market. And we're going to delve into all three of them, but we're going to start with the market. So when most investors, when they look at a deal, right, they focus on one thing, and they focus on the projected return. I told you I'll say that over and over, but they focus on that number. If someone tells them, hey, I have a deal that's like 23% average annual return, you're like, well, the S&P is giving me 7, 23 sounds amazing. But those returns, they mean nothing if the market is not strong, because then those returns really don't have anything. They don't have any backing, and they're most likely not accurate. Like I told you before, right? Real estate is a business. So a property is only as valuable as the demand for it. And so when you think about demand, you're thinking about, people, you're thinking about jobs, you're thinking about economic activity. That's the things that you have to be thinking about, right? Because when you have a strong market, it can really make like an average deal very successful. But a weak market will destroy even the best business plan that you have. So how do we determine if a market is strong enough for the investment, right? We look at three things, which I just brought up. So we look at population growth. Are people moving in? Are people moving out? We look at job growth. Are businesses hiring, or are jobs disappearing? And then the last thing that we look about is future development. Are there signs of long-term growth and investment? That's what you're thinking about when you're trying to figure out if a market is a good market. The first thing that I want us to delve into is population growth. And this is one of the easiest ways to tell if a market has strong demand, right? So when you think about it, when more people move into a city, right, they need a place to live. And so what that does is then they go rent, right? And that increases the demand of rentals. And that increase in rental demand it drives the property value up, which is good for you as an investor, right? But on the other hand, if people are moving out of the city, there's more vacancy, rents are not growing anymore, and then eventually properties, they start to decline. So as an investor, right, I want you to focus on high growth cities when you're looking for your next deal, where population trends are positive, they're going up, and they're sustainable. So like if I could give you an example, right, if you think about Austin, Texas, like Austin, Texas has had significant population growth. That growth has now led to increase in rental demand. And so there's very strong appreciation for real estate in the Austin, Texas market. If you think about somewhere like Detroit, Michigan, right, population is declining, vacancies are a lot higher, and then property values are falling. So that's how you have to be thinking about where is the right market. You might ask, like, how do we track market population growth? We look at census data. So there's U.S. Census data which would tell you where people are moving. You can also look at like U-Haul migration reports. So you can see like where people are renting big U-Hauls and moving to. That's where market demand is. And then there are economic studies that will actually tell you where people are moving. So the next critical factor to think about is job growth, right? Because real estate is driven by people, and people will go where jobs are going. So you need to be thinking about investing in a market where businesses are growing, where they're hiring, because like I said, higher wages, stronger rental demand, and that leads to a long-term stability. That's why you have to think about job growth. So if a market loses jobs, right, people are going to leave because they need income. And if they leave, vacancies will rise, rents will decline. So how do you analyze job growth, right? Look at where major employers are moving to, or look at major employers in the area. And these are questions that you can ask your sponsor as you're thinking about, hey, do I want to invest with this person? Do I want to invest with this team? So if you look at the major employers in the area, right, are they expanding or are they laying off workers? Another thing you have to check is like, think about industry diversity. So if a city depends on one industry to survive, so like maybe like a coal mining town or military town or like an oil-based city, if they really rely heavily on one industry, it makes them more vulnerable to any economic downturns that happen. So think about more diverse industry, more diverse industries, because that will help you. So think of like a city that has maybe tech or healthcare, that has finance. All of that helps, in thinking about a diverse industry. And you also should follow like corporate relocation. So think about, where are Fortune 500 companies opening new offices? If you kind of have followed what's going on in the last few years, right? A lot of people have left the West and they have started building more corporate relocations in like down south. So think Texas, think Tennessee, think some of the Carolinas is where you're seeing all of these pop up. And when corporations relocate, of course, people come with them. That's how you have to start thinking about when you are looking at these deals. So the last major factor that we'll talk about is future development. This will tell you the city's like actively growing or if it's stagnating. And so some of the things you think about is like major infrastructure updates. Like think about like new highways or like transit, if they're bringing in like transit expansion, so busing system, train system, or if there's airport upgrades, that city is growing. Like for instance, Nashville, they have put in about they plan to put in about $1 billion in the airport renovation. So obviously Nashville has grown significantly. There's been explosive development, population and job boom in the area, and that has helped with that has increased massive rental demand. So that's how you have to think about like what is going on in the market. And like I told you a little bit about like corporate investments, like, right, are large companies moving, where they're moving their headquarters to? Those are things that you have to think about. And then sometimes, there are some government incentives that will make business friendly. They're like business friendly policies that attract new jobs. So that's also something to think about. Anything that will improve jobs will improve people coming to them. That's how you have to think about it. And then so I talked to you, I told you about Nashville a little bit ago. You can contrast that to like St. Louis, Missouri, that has had almost like stagnant growth. And there's been significantly slower economic growth with weaker demand in the last few years. That's how you know if a market is thriving or not. And so when you're thinking about investing in a city that has like planned growth and development, right? If you know this, if you're armed with this information right now, right, it's going to help you to like make sure that you're in it before like things start exploding. So that's how to think about the cities that you want to get into. So just a quick recap as we talk about the market and we move on to talk about the deal, right? Strong markets are very important and they support strong investment. So before we even look at the deal, we have to analyze the market first. We have to think job growth, think population growth, think future development, what is happening. So we covered the 3 indicators, right, for a strong market. I want us to put it into action a little bit. So this is where I want a little bit of participation from the crowd. But imagine if you're evaluating 2 markets for an investment opportunity. So I tell you, you're looking at 2 different cities, right? You're like, okay, I'm thinking about investing in city A versus city B, market A versus market B. And you know that market A, you learn a little bit more about the market and you realize that there's a lot of population growth, right? So you're seeing that the population is growing by maybe 3.5% every year. And that has been happening over like the last 10 years. When you delve more into like the diverse economy, you're seeing tech, you're seeing healthcare, finance, you're seeing that it has like a very, very diverse economic background. And when you delve a little bit more into the infrastructure, right, you see that they're thinking about a new airport expansion that they're talking about. They are also working, I think in the next maybe 5 years, they're going to have a vibrant train system. And so that is market A. Contrast it to market B, which is in another city that you're thinking about investing in. You did your research, you asked the team, you went to a webinar and they tell you kind of like, okay, population has been steady for the last 5 years. They noticed that, but before that, it declined a little bit and then it improved. And then now it's just stayed steady for the last 5 years. And that looked like at about 1.2%. And they also, you also do some research and you learn that like the economy in that market is heavily reliant on manufacturing. And one sector of manufacturing, they've laid off a few people. And so that's something that you have noticed as you're doing your research, as you're learning. And then you also notice that there's like minimal infrastructure. In the last 10 years, they did a little bit, but you can tell that, like when you're comparing, you're like, well, I've seen other cities that have more infrastructure. So those are your kind of your two options, right? So based on what we've discussed so far, and we've talked about the market, right? Which one would you want to invest in? Would you want to invest in market A or market B? So that is something. So I kind of want you to like use the chat, go ahead and just kind of say what you're thinking about or what you think the right answer is. Is it market A that has, population growth at around 3.5%? They have tech, they have healthcare, they have finance. Or are you thinking about population B? Okay, so obviously market A. Or are you looking at market B? You might think maybe you want market B that has maybe had a little bit of declining population, 1.5% per year for the last few years. Pandora also said market A. Okay, so you guys are right. It is market A. And this is kind of what happens if you look a little bit forward. If you pick market A and you look a little bit forward, right, you would see, or even if you look back and you decided to invest and you look forward, you would see that they have experienced double-digit rental growth, right? And there's significant property appreciation that has happened over the last 5 years. And if you invested in this market over the next 10 years, population growth actually increased by about 4%. It kept on track with the last decade. And so investors who got in early, they saw significant gains. But market B, on the other hand, right, you saw increasing vacancies. There was stagnant rent growth. There were more people moving out than moving in, and there was a significant decline in market value. So investors who invested in or who bought or invested in market B, they really struggled with cash flow. And this is real. And this is why understanding market fundamentals is very, very crucial. So even before you look at the deal, right, you have to think, what is going on in the market? So we talked about analyzing the market, right? And now I want to shift to talk about the deal. And these three are just as important. So the market is important, the deal is important, and the sponsor is important. Again, the reality is that the numbers don't tell the whole story. So, I've seen and I've heard about deals that promise like 25% internal rate of return. But these fall apart because sometimes the underwriting is so aggressive because they're like, yes, we can do this. We can turn this property around in 5 years, right? But you don't talk about the hidden issues that come with the property or the business plan that didn't fit the market. So when you're looking at these numbers, you have to really start thinking about how can I compare them apples to apples. So when you are evaluating a deal, right, I want you to ask yourself these questions or ask the sponsor or figure it out or learn and do research. What is the business plan, right? Is it realistic? Does it match the market conditions? What is the business plan that they're going to execute over the life of the deal if I invested with them? And then you also have to ask, what are the risks, right? Because when you invest in properties that are older, they have a lot of deferred maintenance. So think roofs, think plumbing, and there's a lot of high renovation costs that come with older properties. So that's something you have to think about. And then you have to think, like, are the numbers realistic, right? Are the expense projections and the rent growth, do they line up with like what is going on in reality? Because a deal will always look good on first glance, right? But most successful investors, you have to go beyond the numbers because in order for you to understand if this is truly a viable deal. So let's go a little bit deeper and look at the deal. And when we break that down, we're going to look at three factors. We'll look at the business plan, then we'll look at the numbers, and then we'll look at like what is the property's risk profile. That's how we're going to start thinking about it. So first, let's jump into the business plan. Not all deals are the same, right? Your risk and your return depends on your investment strategy. And so every multifamily real estate investment deal, it follows a specific business plan. And that plan will dictate the level of risk. It will also dictate cash flow potential and also return on investment. So when I talk about the business plan, I'm talking about a repositioning play. I'm also talking about a value add strategy, as well as, or just like a really stabilized asset. Those are the things that I'm talking and I'm thinking about. So let's delve into the first one we'll talk about is the repositioning play, right? The repositioning play, these are some of the most aggressive investment strategies in real estate, right? These deals they involve properties that are very outdated. So think like maybe like 1960s, 1950s properties. They're also properties that are very poorly managed, and they're almost in like financial distress. That's what makes them repositioning play, right? The strategy for this is that it involves very heavy renovations. Sometimes you have to like turn around operations completely, and there's significant risk. But also, with significant risk will come also high return potential. So that's where you have to think about like, what is my risk tolerance in the type of deals that I'm going to invest in, right? So when you think about a repositioning play, like you have to think that usually the property is in very poor condition, and it has a ton of deferred maintenance. Like I said, so there's a lot of things that maybe they pushed off, they haven't done, they haven't renovated, and so that will fall on you. In these repositioning plays, like the occupancy can be very low. So occupancy can be like 50, 55%, 60%. They sometimes require you to like significantly lease up. Like, so that means get a bunch of new tenants in after you've done renovations. And also because they're old, they're outdated, right? Rents are below market. So what I mean by below market, I mean that, so when I talk about below market, these are the when you compare them to like properties around the corner, the rental income is significantly lower. And then also you have like large scale renovations that you're doing to these properties. So you're also renovating the inside, you're renovating the outside, you're going to renovate all the amenities and the operations. So those are all the things that take place when you're thinking about a renovation, a repositioning play. But like I said, there's high risk, but also because you need a lot of capital earlier on to do like all of the renovations and to do all the plans and to change it from an operational standpoint, right? You don't get cash flow. So you, in properties like this, like you could invest in the first like year, the first 2 years, you get zero cash flow. But on the upside, appreciation of the property is very significant, and I'll touch on that a little bit. So you might be thinking like, as an investor, why would I want to invest in a repositioning play? The idea is that these properties tend to be cheaper, right? So you buy low, you will aggressively renovate, and then you're going to raise rents significantly. So that's how you make this work in your advantage. So when you then stabilize a property, right, you're going to increase the net operating income. So what's coming into the property, you're going to increase that very significantly. And then when you get ready to sell or refinance, you're selling at a much higher valuation because you've done so much to the property. So that's why this property, sometimes this is an investment that a lot of more risk tolerant investors want to invest in. So I want to give you an example, right? If you think about buying a 200 unit property and it's an apartment complex, let's say it was built in the 1960s, nobody has done renovations on them, the units are very outdated, it's about 60% occupancy, right? So over the next 2 years, if you invest in this property or you buy this property, right, you're going to invest millions into renovating the interiors, renovating the exteriors. You're going to add a ton of modern amenities, and you're going to improve management. You might even like kick out the entire old management and replace them. So think about it, right? Rents will be like $900 in this old outdated property, and you imagine increasing it to like $1,500. This will significantly increase the value of the property, and it will allow you, when you sell, to exit very profitable. But with everything, you have to also think about the risks, right? So like I said, there's higher capital requirements. So in the beginning, you're putting a ton of money in and you're not really getting anything out. It might take longer to stabilize the property. And so these investors, you have to be patient because I'm probably not getting any cash flow for the first year or two, right? And then also, you have to make sure that you understand the market where this is, because if you go in and you renovate and you improve rents and you increase rents from like 900 to 1,500, if the tenants can afford it, then all of that work was in vain and you lost money, right? So that's how you have to be thinking. You really have to understand, and that's why you're here, right? You need to understand it, but you also need to make sure that the sponsors or the team that you're investing with is also understands this, because that's what makes a big difference. So we talked about repositioning play. Let's talk about value add. And value add is what we do at Phoenix. So value add it's a common strategy. It's probably one of the more common strategies for passive investors, because it provides a balance between cash flow and appreciation. So we talked about repositioning where there's no cash flow at all because all of it is going into the property, right? With value add, you get some cash flow and you also get appreciation. So when you think about like what makes a deal value add, right? The property is already cash flowing. So you're not buying a negative property, you're actually buying a property that is already producing income, but maybe the rents are below market. So instead of that delta, which is the difference between what the rents are and what the market is or the apartment complex is around, for repositioning, that was like around 600. But for value add, that looks more like 100 to maybe 250. So you have room to increase the rent, but not significantly. And when you think about renovations, right, these will require moderate, not heavy renovations. So think about like updating kitchen appliances, the flooring, doing some amenities. That's what this looks like. And cash flow was there, right? It was already there, but it's going to improve over time as you continue to renovate and as you continue to increase rent. This is definitely lower risk than repositioning because it's already generating some income. So then you might be thinking, right, why should I invest in this? How am I going to make money? So you have to think about it from like, you're acquiring an underperforming property or you're investing in an underperforming property that's below market. So you have the room to increase rent. And then when you do that, when you improve renovation, and so when you implement renovation and when you improve like operational efficiencies of how the property is doing, you're going to increase your net operating income, so what the property is generating, right? And that's when you increase that, you're increasing the value of the property. So all of this is good. This is the reason why you might want to invest in this. And these properties you're going to sell or refinance in anywhere from like 3 to 7 years with significant returns. So again, let me just give you an example of what that could look like so I could try to bring it home. If you are investing in a 150 apartment unit building that was built, let's say in 1995, right? It has some outdated kitchens, but it's not terrible. It lacks a few amenities, right? But this property is probably like 92% occupied. So it's doing really well. And rents are like maybe 150 below market. So like this apartment complex is a little bit cheaper. If you spent, let's say you went in, or let's say the team that you're investing with, right? They spent about $8,000 to $10,000 in upgrades per unit, right? And maybe they added a fitness center and they improved management. You can now increase rents by, let's say, anywhere around $250. And that increases significantly the property value. So let me put that into like, just so that you can understand that. If you increase rent in every apartment complex, and let's say this was 150 units, and let's just say you didn't do everyone, but you did maybe like 60 or 70%, that looks like hundreds of thousands of dollars a year over the life of the business plan. So that's how you're increasing the value of the property. And you're doing it just by doing like $150, $250 increments after you've done significant renovations. That's how to think about it, right? So, but then what are some risks that you might encounter? Renovation costs can be higher than you budgeted for. So let's say you budgeted 10,000, but construction costs are very expensive, especially since post-COVID, right? So if you estimated wrong, then the property and your returns could really suffer. Also, with rent assumptions, this is another thing I really want to emphasize. You have to understand that market, because if you increase rents and the tenants are not willing to pay or they can't pay, then all the money or all the investment that you put into renovating is almost a waste if you can't fill up the apartment to get that delta, to get that change that you were hoping that you would get from renovations. And again, you have to think about market timing, right? What is rental demand doing? What are economic trends doing? All of that is really important. So I would say that this strategy is for someone who has moderate risk, but also who is like maybe a little bit risk tolerant. And so but they still want appreciation. So they're okay with some cash flow coming in, and then they also love the appreciation that comes at the end. That's how to think about this person who wants to invest in this property. And then the third ones they're the more conservative investment strategies, and that's okay if that's you. They produce cash flow from day one, and the risk is very minimal, but also the upside is also minimal because these apartments are already renovated, they're newer, so over time they don't appreciate as much, but you're getting cash flow from beginning. So what makes it attractive, right? Why would you want to invest in this? Well, they have higher occupancies. These are like 90, 95% occupied. And these tenants are long term because these properties are sometimes brand new. And there's no renovation to do because a lot of them are brand new. So all of your expenses are significantly lower. And then also, a lot of these markets are located in like very stable markets. A lot of these properties are in very stable markets. Again, we talked about the market. So you as an investor, right? If you want predictable income with very low volatility, this is the business plan that you want to invest in. This is the type of deal that you want to invest in. And how you make money from this deal, right? You will always be getting steady cash flow, and then you have gradual appreciation over time. So now you're thinking like 7 to 10 years, as opposed to maybe the repositioning of the way you were going to go and sell in like 3 years. You're holding this for much longer. And then you will get also tax advantages. So think about depreciation. So if you're a high net worth investor or high income earner here, then you are thinking about ways to offset some of your taxes, and depreciation is one of them. So now the example I can think of for this is like if you had maybe like a 200 unit luxury apartment, it's in like a high demand city, it's maybe 95% occupied and rents already a market rate, right? So investors are just getting steady cash flow, and like the risk is minimum. Like, so I said that before, but I'll say it again, right? This strategy is for investors who just they're like, I want stable income, I want minimal risk, I don't really want aggressive growth, I just want consistent returns. That's the most important. So this type of deal is for you, and this is the business plan that you maybe want to align with. So we talked about the market, we've talked about the business plan. I want to dive into the numbers, and I don't want to get in the weeds with the numbers, but I want you to understand it, right? Because the best looking deals, they will fall apart if the financials don't make sense. And a lot of investors, like I said, are focused on those beautiful numbers. So they're like, how can I triple my investment in 5 years? So like if someone gives you an investment opportunity and they're like, you could 3x your investment, I just want you to pause and ask, is that possible? Are these numbers actually achievable, right? So when you think about that, you're thinking about what is the revenue and the rent growth assumption? What is the team? What are they assuming that will happen? Like, like that, market A versus B that we looked at, where we're like, okay, rent growth is and population is around 3.5%. That seems feasible if you look at the market. And then sometimes you have to also ask, like, does the deal assume rent increases that are above market trend? So if you look at the deal that's like, yes, you will 3x your money, but they tell you that like they're going to increase rent to way above market. So let's say market is at like 1,500 and they're like, we're going to increase our 1 bedrooms to 1,900. Well, that's not realistic, right? Because nobody's paying for that because the market is not demanding that. So you also have to think, like, is there data to support, occupancy projections? So what has been happening with occupancy for the last 10 years? When we use CoStar to do a lot of our market projections, but what is CoStar telling that's going to happen to rents in the next 5 years? What are they saying is going to happen to occupancy in the next 5 years? We track all of that data to help us make the right decision. If a deal is assuming that like rents are going to grow by like 7 to 10% every year in a market that, like, let's say in the last 10 years, they only grew by like 3%, I need you to ask questions. I need you to be cautious. I need you to be thinking, is this possible? So another mistake that a lot of investors make is that they trust the expense projections and they don't check if it's realistic. So if you understand, let me just give you kind of a little bit, because I told you this is a business, right? So in the business, income comes in, and so when income comes in, expenses go out. What's left is your net operating income, right? So you need to make sure that the expense projections make sense. And a lot of deals would look good on paper, but like the expense projection is very underestimated. So if they tell you, if you're looking at like a 1980 property, your expense ratio should be about 50%. That means of all the income coming in, about 50% should go towards expenses. That makes sense. If someone brings you a deal and they're like, well, we're gonna shave expenses, it's gonna be about 35%. It's not possible. Just that deal is not going to work out, because after they acquire that, they will really very quickly realize that the expense projections for that type of vintage of property is really more around 50%, right? And a lot of the things that affect expenses, because you got to know this, Property taxes. So in a lot of cases, right, taxes will increase significantly after a sale. So I want you to ask the team, did they underwrite or did they factor that property taxes are going to go up? Did they factor that in their underwriting? That's very important. And then the next thing is insurance costs, right? Insurance, if you notice, like with all of the natural disasters, with everything that has been happening, insurance costs have skyrocketed over the last few years. So a lot of markets have seen significant increase in insurance. Are they estimating too low? That's what you have to ask. You have to make sure that you understand that. And then payroll and maintenance usually goes up. So make sure that these projections are not below market, are not below industry standards, because you're not going to get someone on payroll that's going to take less than what the neighboring apartment complex is doing. So if a deal is assuming that expenses will stay flat or if expenses will decrease, I personally don't think that it's realistic, because more than likely, right, when you acquire a new property or you invest in, expenses will probably rise over time, and then you manage it better, and so then you're able to shave some, but that comes with a little bit of time. So now we've kind of talked about expenses, right? I want us to talk about reserves and capital expenditure. So a lot of, with the repositioning and the value add, a lot of what we do is renovations, right? So do you have enough reserve for repairs, for upgrades? That's something you have to think about. You have to ask, right? A deal can be financially solid, but there's like no budget at all for major repairs. That investment will become a nightmare, because they will come back to you as the investor and ask for more money because they did not budget that in the beginning. So things that you have to think about, right, when you're thinking about like repairs and upgrades, and I touched on that a little bit, is what is the age of the property, right? How has the property been managed? Has it been well maintained? Or when you acquire it, will you have like a lot of costly repairs over time? And then also you have to think about big ticket items. So think about roof, think about plumbing, think about HVAC, all these structural issues. Like, have they been looked at in the recent past? Because some of these expenses are like six-figure expenses, and you have to budget for that. So now think about also your emergency reserve fund. So no matter what, you still have to set aside money for just in case, right? So you have to have money in reserves. And even when you renovate, you still have to have contingency plan that's built into your renovation plan. Because you as an investor, you need to be protected against like unexpected repairs or even market downturns. So those are things that you really have to think about. If a sponsor is not budgeting for capital expenditures, please don't be surprised if you get a phone call saying, hey, we need more money because we didn't budget for it. And that is not okay, right? So think about it. What are they doing? Think about like how they are structuring it, how making sure that there are additional reserves for just in case. So we talked about that. We talked about capital expenditure and reserves. I want us to talk a little bit about loan terms, right? The thing that you have to understand that is like there's a significant difference between a successful investment and a financial disaster, and that's in how these loans are financed. So what I want you to think about and understand, and if you bought homes, you can understand this, right? There's fixed rate, and so that is like the rate stays the same over time, and then there's floating rate, which means that rate changes over time. Floating rate debt, it can be very risky, especially if interest rates are rising unexpectedly, which we have seen in the last 2 to 3 years. So people who bought floating interest rates or floating debt, those properties have struggled in the last few years because interest rates have been increasing. Then another thing to think about when you're evaluating the loan terms, right? Look at the debt service coverage ratio. What this means is that the property has to be making 1.25 times the cost of the debt. That means that property is doing well. So if a property is not making enough to cover their loan payments, or they're making just a little above their loan payment, that deal is very fragile. You've got to ask questions because that deal will struggle. And then with the loan term comes the exit plan. So you have to think like, if there's a balloon payment that's going to happen in 3 years, if the length of the business plan is 5 years, well, what's going to happen at year 3? Where's all that money going to come from? So you have to be thinking about, does the business plan align with the time frame of the deal? Also, what you have to keep in mind is that like if a deal is very over leveraged, so like if there's too much debt on the deal, or if it has, floating rate financing, like I talked about. And if that floating rate financing doesn't have an interest cap rate, so like you buy that way, you say, okay, I got a good floating rate, but I don't want my interest rate to go above this. And so you can buy a cap rate. If it doesn't have any of those things, I want you to know that you could lose money if interest rates rise. So you have to understand this is why it's really important to go into the numbers, because you have to understand them. So we talked about the deal. In the deal, we talked about the numbers, we talked about the business plan. Now, I want us to think about, like, how do we evaluate a sponsor? And this is important because the best deal in the wrong hands, it'll struggle. It really will struggle. And I even want to say that it might collapse. So we talked about the market, right? And we talked about the deal. Now, all of that doesn't really matter if the person that is managing the money isn't qualified to execute on the plan that you came up with. Great market, great deal, bad sponsor. So as you have you have to be thinking about that. And I've seen incredible deals fall apart because of poor management or bad decision making or lack of investor transparency. All of that is very important, right? So when you think about what makes a good sponsor, you have to look at their track record. So look at, have they managed similar deals in the past before? Have they partnered with other, investments, with other investment firms who have managed similar deals in the past? You have to look at their past projects. How did they perform? How did they do? Did they successfully execute on the business plan? If they did a value add or repositioning play, think about that. You have to ask those questions, especially if that's the deal that they're bringing in front of you, right? And then think about decision making. So how do they handle challenges? Because I will tell you, challenges will come. But how have they, what has happened to the other deals during, if there's been market downturns, right? How have they dealt with that? If they've had a failed deal, it happens, right? How did they manage investor losses? What did they say about it? How did they communicate that? How did they try to remediate the problem before it happened? Those are things that you have to think about. And then in terms of investor communication, right? How transparent are they? Do they tell you every step of the way what's going on with the deal? Because it's very important, right? You need to make sure that you're getting regular updates. It could be monthly updates. It could be quarterly updates, even before acquisition, right? So you know what you're getting into. You know, okay, this is the amount of time they're going to update me. I expect that even moving forward. And also you have to think about, how do they respond to investor concerns? So if you get an email, a phone call, are they quick to respond? Those are all things that are really important. If a sponsor doesn't have a track record, or if they don't answer your questions, or they don't have a clear risk mitigation plan, or if you ask them for referrals and they don't send you to a prior investor, these are all major warning signs, and you have to take that into effect. So we talked about those three factors, right? And I want to break them down in just a little bit of detail. So the first thing that you have to think about is, I need you to evaluate their track record. How have they done in similar deals in the past, right? What are the number of deals that they've completed? Have they done multiple transactions, or have they partnered with people who have done multiple transactions? That's also important. Have they successfully closed deals in different market cycles? That is also important. And then look at their portfolio. Do they specialize only in multifamily, or in commercial, or in development? If they do, and they're now maybe bringing you a deal that is maybe an office space deal, you might ask, you might think, maybe I should be cautious. This is not their area of expertise. That's how you have to be thinking about every step of the way, the sponsors. And then when you think about performance, right? Did they meet or exceed their projected return? So if they said, this is what we can get you, did they meet that? Did they exceed that? And then if they've had deals in difficult market conditions, how did they perform during COVID, or how did they perform during economic downturns? Those are things you have to be thinking about, and you have to be asking yourself. And another thing is challenges that they faced, right? Every investor faces challenges, that happens, but how did they handle those tough situations? That's something, because a good investor is very honest. They'll tell you what went wrong. They'll tell you how they fixed it. They'll tell you if there's a delay in the plan or in the execution plan. Those are conversations that you have to be willing to have with your investors. Those are important. So just be thinking about that. So that is how you look at the track record. Another thing that we have to think about is, right, think about like how they make decisions. It's very important because the difference between a great sponsor and a bad one, it's not just in how they manage success, but it's in how they handle diversity. And that's like, sorry, how they handle adversity, not diversity. But that is also something that's very important that you have to think about. If things are going bad, how did they handle that? Have they, like I said just a second ago, right? Have they managed deals in economic downturns? What does that look like? It's easy to succeed when the market is going well, but what happens when the market is not going well? Now, they may have never been tested during that market, but at least ask the question, have the conversation, see what they say. How have they handled market challenges? If interest rates go up, which it happened in the recent past, right? Or if occupancy drops, what plan do they have? What is their contingency plan? How do they restructure a deal so that investors are protected no matter what? I, I want to just like put these nuggets in your mind and your brain so that you can be thinking about that. And what is the risk mitigation approach, right? How do they stress test a deal for like best case scenario, worst case scenario? Are they conservative in their underwriting? Making sure that like they don't overpromise and underdeliver. Pay attention to that. You know, if a team or sponsor tells you like nothing will go wrong, everything is guaranteed, I want you to run in the other direction because that is very, very far from the truth. Things will go wrong, but how do you deal with it? So we talked about how to handle adversity. We talked about track records, and now I want us to talk about communication. Because as an investor, right, you are putting your hard earned money into the deal. You deserve transparency. You should know what's going on. Good, bad, ugly, you should know. So think about like how does the sponsor communicate? Do they send regular updates? You should be receiving at Phoenix, we do monthly updates. So you should be getting monthly updates. And then you can also do quarterly financials and operational updates, but we just find it easier to make sure that our investors know what's going on a monthly basis. So we will send you financial reports and we'll send you maybe like a 2-pager on how the property is doing. Do they hold investor meetings? So, like, are they hosting webinars to talk about deals? Do they have Q&As if that needs to keep the investors informed? That's really important. And you have to also ask, are they accessible? So if you send them an email or if or do they pick up the phone and call you, have a conversation with you? Do they respond? All of those things are really important in transparency because it makes a big difference to know that like you feel safe, that you feel like your investment is safe in good hands. So that's how I want you to think about, right? We talked about the market, we talked about the deal, and now we talked about the sponsor. What does a great sponsor look like? We talked about how they deal with adversity. We talked about the track record. We talked about transparency and communication. All those things are important. Now you know what it is to invest in a good market. You know how to look at a deal. You now know where your risk align with and what strategy is best for you. So we've talked about all of that, right? I want to talk about kind of takeaways and then walk you through a case study, and then we will wrap up. So we spent the entire session talking about really how to evaluate the market, the deal, and the sponsor. And that's important because as an investor, you deserve full transparency and confidence in your investments. So at Phoenix, right, we don't just say that we do things differently, we prove it in our actions, right? So the first thing we do is an investor first approach. So we invest our own capital alongside investors in every deal because we believe in alignment. So my money is at risk as much as your money is at risk. And so like I'm working very hard for your investment as well as my investment. And so if we don't believe in the deal enough to put our own money, I won't bring that deal to you. That's just how important that's how important it is when we think about like an investor first approach. And then also what we do is we have a very rigorous deal selection process, right? And so we review thousands of deals. We literally review thousands of deals, and we analyze hundreds, a few hundred is what we analyze every year. And from that, we only move forward with like the top 1 to 2%. And those are the deals that we put offers into. So every deal truly goes through like stress testing. We have very conservative underwriting, which is probably why we're not getting awarded a lot of deals, but we are okay with that. And then we do a ton of risk assessment, and we get input from our external team. So our property manager, our lender, our insurance, we get all of these, we get outside feedback before we know that we're moving forward with putting in with putting in an offer into the deal. So that's what it looks like in terms of our rigorous deal process. And then, we have proven kind of risk mitigation strategies that we do. So we start off with very conservative projections instead of like very optimistic rent growth. So you see our rent growth around 2.5%, 3%, 3.5%. And that's really important. And we always make sure that we have very strong cash reserves and contingency plans for every single deal that we put an offer in, every single deal that we bid. And our goal is long-term value creation. So we're not, you will get cash flow and you'll get returns, but think about it from we are more invested in a long-term approach than just short-term gains. That's the most important thing for us. And at the end of the day, what's very important is that investors are taken care of. And so we have, we do our best to make sure that you get communicated with what's going on as we acquire the deal, as we go through with the deal, as we're now managing the deals. You are very aware of there. And like I said, we create detailed reports every month. We make sure that it goes out so that you know what's happening with your investments. And we will have regular webinars to update you, even just like this one, but more deal specific into how the deal is going. And I want to say that I'm accessible. So anybody or any member of our team will definitely reach out to you, talk to you, and kind of walk you through what's going on with the deal. The truth is that trust is built on communication. And so that's what we want to stand for. And that's what we're talking about today. And so when you invest with Phoenix, right, you're not just getting into a deal. You're partnering with a team that really puts your interest first, that really protects your capital and really prioritizes transparency. I think that's what, like, if we had to like put a stake in the ground, that's what we stand for. And the truth is that when you succeed, we succeed. That's how we think about it. So I want to walk you through one of our deals, just so you see how this comes to life. We've talked about all these factors that make a strong investment, right? And I want to be transparent and show you what that looks like in real life. So we'll talk about Grove Park View, which is a recent deal that we brought to our investors. And I want to break it down and show you like how this meets all the criteria that we just discussed. And what makes it special is that it's truly a perfect alignment between those three factors, which is strong market fundamentals, a really well-structured deal, and an experienced sponsorship team. So I'll walk you through that real quickly, just so you see how we think about these. First of all, we'll talk about location. Grove Park View is in Gwinnett County, and it is experiencing exceptional growth. So like the projection is that in the next like 5 to 7 years, it is truly going to be the largest county in all of Georgia. This is not speculative information, right? It's backed with like a ton of major economic development. So if you saw the news maybe 2 months ago, you know that Rivian plant is coming into that metropolitan area that Grove Park View is in, and it's going to bring thousands of high-paying jobs. That's how we were looking at Grove Park View, right? And it has a very impressive track record because it has been 95% occupied, so 95% occupancy for like the last 10 years through multiple market cycles, through COVID. So that's how you know that like it is definitely a strong market that we're investing in. And because education is such a key driver, right? Wherever schools are good schools, families are moving there, and like they need to rent, they need a place to live. So that's also something that's factoring into where we are into our market. So Grove Park View is actually in a market that has the second best high school in all of Georgia. So it's, like I said, it's very attractive to families. So all of that is great, but even more importantly, right, in our investment thesis, we actually realized that there's very minimal new construction in that area where Grove Park View is situated. And what that means is that like there's a lot of like supply constraints. So there's not enough supply, and so demand is going up rent growth is going up, appreciation is going up. That's what made this deal like a great market location when we thought about it. And that's the reason why we like said yes. And of course the numbers made sense, which I'll talk about right now because we're talking about the deal, right? We structured this deal with preservation of capital as our first priority. And so even that I told you that the property had like 95% occupancy, right? When we underwrote this deal, we were conservative and we were like, okay, we will do maybe like a 7 or 8% vacancy assumption. So instead of knowing that the property is at 95, it's actually at 96 right now. We still said that we're going to project that occupancy is going to go down to 93%, 92%. That's what makes it a conservative deal. And then with our value add strategy, right? The seller has already proven that the value add strategy is working because the seller renovated some of the units and was able to increase rents of an average of like $210. But one thing we're going in there doing is like the studios, right? The studios are really large and we're going to convert them to one bedrooms. And that single change alone is going to produce like an exceptional rent upside. So think about it, right? The studios, which we were budgeting for about like 900, we can now, when we convert them to one bedrooms, we can now charge anywhere from like 1100, 1200 and that's because those studios were really big when we went to go take a look at the properties. So that's also another way to increase the value of the property, right? And we projected that rent growth would be around 3% annually. But over like the last 5, I think, to 8 years, right? The market rent growth has been significant. It's been like 8%, 10%, but we wanted to be very conservative and keep it at 3%. And we are saying that we're going to go in, our capital expenditure plan is that for every unit that we renovate, we're setting aside about $11,000 per unit. And that makes sure that we have like enough reserves and enough to actually go in and repair and renovate the properties that we want to. So that's how we're thinking about when we think about the deal. And then, the financial structure is really amazing because we secured an assumable debt of 4.74% over the entire life of the deal, which we are doing a 5-year business plan. And if you notice like what's going on with the interest rates, it's coming down now. So we're really excited, but it's still like in today's economy, you can't get 4.74%. So that was really exciting. And when we think about the team, this is the part that kind of gets me really excited because the team as a whole who is executing on our business plan, we have about over 3 decades of like combined experience in multifamily investing in real estate with a heavy focus on value add. That really excites me and it tickles me because I know that like, our investors are in good hands, right? What sets us apart, like I said, as sponsors, and that's what I alluded to when I said our investors first, is that like we invested our capital alongside yours in Grove Parkview. We have skin in the game. And because I really think it's really important that we have complete alignment of our interests. And I can say that we do. Another thing is like with our team, right? We are very hands-on. So in every step of the way from acquisition, as when we start renovation, ongoing management, we are very hands-on. And there's nothing passive about our approach. Like we want to continue to drive performance. And we're starting with like even like during acquisition all the way to the end. And we believe in transparency. And so even before we closed, you were getting monthly updates from us and kind of throughout all of the acquisition process as we, with ongoing operations, every step of the way you were getting informed. And I think that that's very important because you know what's going on. And so when you have that combination, right, a growth market with supply constraints because not a lot's coming in, a deal that was structured very conservatively, and then with multiple value add components that we want to do, and then really truly experienced sponsor that is aligned with the investor, all of this makes like these are all the elements to a really great deal. And it's really good because then as you invest in a deal like this, you know what it means to be a sophisticated investor because you're asking those questions and you're seeing it in real life. So if you want to talk about Grove Parkview or any other of our other investment opportunities, I'm available, or one of our team members is also available. So we've covered a lot today and we are wrapping up, right? But there's one thing that I want you to take away, and it's this, right? A great investment, a phenomenal investment, is not just about high returns. It's about strong fundamentals. And that's what I want you to really take away today, because I want you to know that the market really matters, right? If jobs and population aren't growing, that is a red flag. The deal has to make sense, right? So you have to have a strong business plan, a very realistic underwriting, and you have to have risk mitigation, because all of that is very critical. And then the sponsor is key. You have to have the right team that can protect and grow your investment. That's very important. So that's what I want you to take away, that like it's really all about strong fundamentals. And when you combine all these three elements, that's when you get like a smarter, safer investment decision. That's how you build long-term wealth. So that's very important. So this part is really exciting to me. So we created the Ultimate Passive Investor Playbook. And we created this as a guide to really help you navigate real estate investing with confidence, right? Everything that we discussed today, the market, the deal, the sponsor, is covered inside of this playbook. It will give you a structured step-by-step approach in how you evaluate every opportunity that comes your way. And the goal, the ultimate goal, is that I want you to become a very sophisticated investor. Someone who, like, if you see those flashy numbers, you're going to look away. If you see the big promises, you're going to look away, because now you understand how to really assess a deal, and you understand what it means to be a smart investor and to make smart investor decisions. So whether you're new to passive investing, right? If you've never invested before and you're looking to sharpen your strategy, this playbook will give you the clarity that you need to invest, and to invest with confidence, right? And the best part is that it's all yours for free. So I think we have put up the website, so you can go on that website and then you can just put in your information, and the playbook will be sent directly to your email. If you use it, which you should, and you find value in it, please let me know. I think that like we put in a lot of time, effort, resources into it, but I think it's actually really worth it. So before I end, right, I want to share a new community with you, which is the Expansive Circle. And the premise behind the community is to break free from all sorts of limitations in order to create a life where you can truly feel alive, you can feel fulfilled and really free, right? It's one that's like, it's when you are in the community, you're thinking about how can I design a life that is abundant in wealth, in time, and in experiences. Because when we grow together, when we expand together, when we achieve together, we're going to transform together. So inside of the community, right, you have support, you have a ton of like implementation tools, you'll see a ton of investment opportunities that are coming your way, with a lot of like high level networking and connections inside of the community. You have monthly masterminds and expert sessions, all to help you grow as a professional. So as you think about like how can you transform success into freedom, into purpose, into impact, I want to encourage you to join the community. It's not just another networking group, right? Or it's not just another professional association. It's a community of like really purpose-driven achievers who are committed to redefining what success really looks like. So if you're interested, we just put the link. And for the first 50 people, it is free access for a year. And that is just with the code founder. So lastly, before we truly wrap up, I know that for many of you, right, this may be the first time that you are diving into passive real estate investing, or maybe you've looked at deals, but you still have questions about how to confidently move forward. And I also know that like when you're trying to figure out like where to invest, who to trust, how to ensure that you're making the right decision, it can feel very overwhelming. And so I wanted to offer something special today, right? I want to offer a free, just one-on-one consultation. And the goal is to help you get clear on your investing goals. Not a sales call. It's just an opportunity for us to have a real conversation about your wealth building strategy, your long-term financial goals, and how Phoenix can help you get there, like how we can align together and help you achieve your financial goals. So I don't think I've ever done this before, but I know how important it is to have a trusted partner as you like figure out this whole journey. So I want you to take me up on this offer. I promise I will wow you. But at the very least, right, you'll walk away with really great clarity on the next steps that you should take. So I only have a few of this because I don't have a ton of time. But if it sounds like something that would be valuable to you, go ahead and just like click. My calendar has been put up. Just click on it, set up a time. I'd love to connect with you and really help you take the next steps in your investing journey. So I'm pretty sure that the calendar's up. Go ahead and click on it and just jump in. Okay, so as we wrap up, I want to tell you that knowledge is very powerful, but knowledge can only go so far, right? Action is what creates wealth. So now you know how to analyze a deal. I want to give you the tools to really start applying it. So the first thing I want you to do is go ahead and download that Passive Investor Playbook. It really is a step-by-step guide to help you apply everything that we've covered today as you embark on your first deal or even your 10th deal. And the next thing is to join the Expansive Circle, where it's just going to be access to growth and future investment opportunities, market insights, and just a ton of investor resources. And the third one is to schedule the free consultation call. So if you're interested in learning about deals like Grove Parkview and our other deals, let's have a conversation. I want to leave you with this final thought. Great opportunities, they don't wait around, right? They come and then they go. If you are serious about investing, about building long-term wealth, if you're interested in investing a lot smarter, then I just want you to let's take the next step together. Let's go ahead and, let's do this together. Let's go ahead and look for great deals and let's invest and let's grow wealth together. So I want to say thank you. Thank you so much for your time today. Thank you so much for joining this session. And I look forward to helping you build wealth the right way. So thank you again. And if you have any questions at all, dump them in the chat or in the questions, and I would love to respond to them. Yes. So any questions, feel free to toss it in the chat, and thank you. I'll give everyone a second if you have any questions. Okay. If there are not any questions, we will go ahead and wrap up. I hope that you were able to take something really amazing from this, and I hope that you'll take this. What I want you to do is I want you to implement. So I want you to go out and take action, because I think that's the most important thing. So thank you, everyone. Have a wonderful night. Thank you so much. Very informative session. Thank you. Thank you. Thank you. Thanks, everyone.